Welcome to the Deep Dive. Today, we're tackling a development that, it promises to fundamentally rewire how trillions of dollars view digital assets.
It's a big one. We're talking about the world's largest asset manager, BlackRock.
The firm that manages more money than the GDP of several major nations combined. And they've made this monumental regulatory filing all about Ethereum.
And what BlackRock is doing here, it isn't about, chasing the latest market hype. It's a really strategic move.
Right.
It's acknowledging that crypto has moved past just pure speculation. For years, the story was simple. Buy it, hope the price goes up, and maybe sell it later.
A pure price play. That's the speculation model we've all been living in. But this filing, which some analysts are already calling the blueprint for a superhighway for capital, it signals that the institutional world isn't just interested in price anymore.
No, they want something familiar.
Something safe, something Wall Street is built on. They want yield.
Precisely. We are seeing the whole story of major crypto evolve to include steady, productive income. So our mission today is to break down exactly what BlackRock filed, how staking actually works.
And why this effort to combine, the high growth potential of Ethereum with the stability of an income stream has these massive implications for global finance.
We're going to show you how this bridge connects crypto to concepts you already know, like dividend stocks and bonds.
Okay, so let's unpack this filing, because it was done very quietly, but with incredible intent. On November 19th, BlackRock's iShares decision.
And they are the absolute titans of the ETF world.
They filed paperwork in Delaware. They established a new legal entity called the iShares Staked Ethereum Trust.
And that initial Delaware filing, it's really a procedural step. Think of it like reserving the domain name for a multi-billion-dollar business.
It's the first shot fired.
It is. It confirms their intentions. But the type of fund they're proposing, that's what's truly revolutionary. We need to clarify this distinction right away.
Okay, because many people listening will know we already have Ethereum ETFs, even from BlackRock itself. How is this new trust fundamentally different from those?
It's a completely different investment thesis, a whole different animal. Existing Ether ETFs, like BlackRock's own, are designed for one thing, simple price exposure.
Right.
You invest $100, ETH goes up 10%, you've made $10, your entire return is based just on the market price moving.
That's the speculation model again. You're just holding it, waiting for growth.
Exactly. But the new iShares Staked Ethereum Trust is designed to do two things at once. It will track the price, and it will put the asset to work.
How does it do that?
It takes the Ethereum it holds and uses it to participate in the network staking mechanism, passing those network rewards, that income, directly to you, the investor.
That distinction is just. It's crucial because it shifts BlackRock's business model from being a simple custodian to being an asset manager that is leveraging the network's utility
To generate passive income for their clients.
So they're selling a dual product, growth potential, plus a steady income stream.
And this is what institutions require. Think about it. Pension funds, endowments, they don't just want volatility and hope. They need predictable income streams to meet their obligations. This fund is built for them. So to really get why they're so interested, we have to understand the mechanism behind it all. Staking.
Right.
Simply put, staking is the process where you lock up your Ethereum, you don't spend it, and you use it to help validate transactions and secure the entire network.
So you're providing a service. You're basically acting as a validator for the digital ledger.
You're the engine running the whole thing. And in exchange for providing that critical service, the Ethereum network itself pays you a reward. It pays you a yield in more Ether.
It's sort of like an interest payment.
Very much like an interest payment or, a dividend on a stock.
And here's where we hit that magic number that has every asset manager buzzing. The current estimated yield from staking Ethereum is hovering right around 4% per year.
That 4% is transformative, especially when you look at it against, say, traditional fixed income markets. Think about current global interest rates. A 4% yield on a high-growth asset like Ethereum makes it incredibly competitive. It transforms it into what some are calling a hybrid asset.
Part growth stock, part income stream.
You got it.
Wait, but that 4% argument, it kind of assumes it's going to remain stable, right?
Yeah.
Given Ethereum's network dynamics, how much is staked, transaction volume, do we have data that suggests this is a stable enough income stream for, say, a cautious pension fund?
That is exactly the right question to ask, because unlike a bond yield, which is contractual, the staking reward is dynamic. It changes.
So it could go down.
It could. If
Well,
more ether gets staked across the network, the percentage yield for everyone actually goes down because that reward pool gets distributed among more validators.
but it could go up too.
Yes. Conversely, if network activity is high, transaction fees can push the yield higher. So BlackRock is marketing the potential for 4%, but institutions have to factor in this volatility in the yield itself.
And what about the risks? You hear terms like slashing and unbonding. Traditional investors will want to know their income won't just vanish.
Which is why institutional-grade custody is so critical here. Slashing is the penalty. You lose a bit of your staked ETH if a validator acts maliciously or even just goes offline.
And BlackRock can prevent that.
Well, they can minimize that risk to near zero by using professional institutional-grade infrastructure. And they also have to address the unbonding period, the time it takes to unlock your assets, which can be days or weeks. That's a liquidity concern they have to detail in their filings.
Okay, let's turn to the scale of the institution making this move. BlackRock. They manage roughly $13 trillion in assets.
It's a number that's almost impossible to really comprehend.
It's larger than the entire Japanese economy. They don't build products like this unless they know they can move massive amounts of capital into them.
Exactly. When BlackRock moves, it's not a market ripple, it's a tidal wave. They're building this because they have clients, pension funds, huge sovereign wealth funds with these gargantuan pools of capital just sitting on the sidelines waiting for a secure, compliant way to access that 4% yield.
And this leads to something people are calling the adoption flywheel.
Mm-hmm.
How does BlackRock's involvement create this self-reinforcing dynamic?
The flywheel is really about 3 steps that feed into each other. So step 1, legitimacy and demand.
Okay.
When BlackRock, the most powerful name in finance, launches this, it legitimizes Ethereum's status as an income-generating asset for all of traditional finance. That triggers massive client interest.
That's the signal to everyone else that it's safe to get in the pool.
Then you get to step 2, which is the supply shock.
Yeah.
Every single dollar invested in this staked Ethereum trust means the underlying ether has to be bought and then immediately locked up for staking.
So it's taken off the market.
It removes a tremendous amount of ETH from the free-floating tradable supply and decreased supply when it's met with increasing institutional demand.
Typically results in upward price pressure. So the very act of generating yield for their clients simultaneously drives up the price of the asset.
Precisely. Which leads to step 3, the narrative completion. The market fully shifts its view of Ethereum from just speculative tech to a productive, yield-bearing asset.
And that opens the floodgates for even more conservative capital.
The most conservative pools.
So to quantify this, we know the Bitcoin ETFs pulled in, north of $30 billion. The first wave of non-staked Ether ETFs saw around $15 billion. What are the projections for this?
Well, analysts are projecting the staked version, specifically because of that added income stream, could attract anywhere from $5 to $20 billion on its own in just the first few years.
Wow. And that's capital moving for income stability, not just for price momentum.
A completely different motivation.
Oh, yeah.
But as exciting as all those projections are, we have to temper expectations a bit here. This is not a done deal.
Right. BlackRock's $13 trillion doesn't let them just skip the line.
Not at all. They're facing a regulatory marathon, and this product has some serious hurdles.
So the Delaware filing was just step 1, registering the name. What are the major steps they face now with the SEC?
The main event is the submission of the S-1 prospectus. This is a super detailed, comprehensive document.
The Bible for the fund, essentially.
Yes, it has to detail everything. The risks, the custody solutions, how they'll manage the staking yield, the penalties, all the financial disclosures. That S-1 submission is what starts the formal review clock with the SEC.
So the Delaware filing was the announcement. The S-1 is the full blueprint that the SEC will scrutinize for months and months.
Exactly. And then after that, the stock exchanges themselves, like the NASDAQ or the NYSE, they have to submit their own filings to get approval to list the product.
And those two processes run in parallel.
They do. And both are prone to slow-moving government bureaucracy.
So given this, regulatory traffic jam, what are the experts predicting for a timeline? When could we actually see this?
Even with BlackRock's immense resources, this is a slow, methodical process. The consensus view suggests that the absolute earliest we might see an approval is sometime in mid-2026.
Mid-2026, so we're talking years, not months.
Absolutely.
Yet analysts are still putting the odds of approval by then at a surprisingly high 80%. Why so much optimism, given the SEC's historic caution?
It really boils down to due diligence and institutional weight. That 80% figure is based on the assumption that a firm like BlackRock, which is so cautious and so politically savvy.
They wouldn't have started this unless they thought they could finish it.
Exactly. They wouldn't waste the time and capital unless they'd already received strong, informal signals from key regulators that a viable path to approval exists. They likely believe they've already figured out the answers to the SEC's biggest questions.
But that still leaves a 20% chance of delay or rejection. What's the most likely source of friction there?
While the SEC's primary sticking point could still be the fundamental mechanics of staking itself. They might try to classify the yield payment as an unregistered security, or they could get hung up on the complex custody arrangements needed to keep the assets secure while they're also being staked. And of course, just good old-fashioned bureaucracy is always a risk for delay.
But beyond the regulatory friction, there's this fascinating ideological conflict coming from within the crypto world that we need to talk about.
Yes.
The risk of centralization.
This is a critical concern, and it goes right to the heart of what decentralization is all about. The entire ethos of Ethereum is to be trustless, open, and resistant to central control.
And a giant like BlackRock entering the space threatens that.
It could. If institutional giants, through a trust like this, successfully gather billions, maybe hundreds of billions of dollars worth of staked ether, they could effectively become one of the single largest, most powerful validators on the entire network.
And what happens when one entity holds that much validation power?
It potentially compromises the network's governance. Validators vote on protocol upgrades, on crucial network decisions. If BlackRock gains too much influence, their decisions, driven by corporate and fiduciary interests, could start to supersede the collective will of the decentralized network.
That's a fundamental tension.
A huge tension between institutional safety and decentralized power.
So what BlackRock is building it's more than just a new investment product. They are installing the highly sophisticated plumbing to allow the largest pools of capital to enter DeFi safely.
Pensions, endowments, sovereign funds.
But that very process introduces a centralizing force into an ecosystem that was specifically designed to reject it.
It's the ultimate compromise. They're solving the liquidity, security, and compliance problems for Wall Street, but potentially at the cost of the network's ideological purity.
So wrapping up this deep dive, BlackRock's filing for a staked Ethereum trust marks this definitive shift in the crypto story. It's moving from pure speculation to productive yield.
Anchored by that powerful, though, as we said, volatile 4% staking reward.
And this move, leveraging BlackRock's $13 trillion scale, it kicks off that adoption flywheel that promises enormous inflows of capital.
Provided they can successfully navigate that regulatory marathon, which, as we project, will probably conclude sometime in mid-2026.
The bridge is actively being built. This institutional-grade infrastructure is making a digital asset look and feel like a predictable, income-generating investment.
And that unlocks pools of money that were previously just, locked out by risk tolerance and regulatory compliance. A massive capital migration feels imminent.
So here's the final provocative thought for you to consider. When a force as huge and powerful as Wall Street enters a brand new ecosystem, it doesn't just show up to play, it changes the rules of the game. It begins to reshape the entire landscape.
The question isn't if this integration will happen.
The key question we're left with is how the immense gravity of traditional finance, with its need for centralized safety and control, will ultimately reshape the very soul of the decentralized world it's about to enter, and whether that soul can even survive the embrace.